Okay, our topic for the week, and really over these next couple of weeks, it's going to be a similar type thing. Over the next couple of weeks, we're going to take a look at financial statement accounts and learn how to do the accounting behind them. This week, we talked about an account receivable and the related sales revenue. And we know what an account receivable is. We've talked about this previously. An account receivable represents money owed to me. I have made a sale to a customer who said, thank you, I'll pay you later. So the account receivable represents the money that the customer owes us. Now, there's one big accounting issue that we're going to have to deal with as it relates to accounts receivable. And we'll get into our example in just a little bit. But I want to lay a little bit of a foundation first. And that one big accounting issue is not everybody ends up paying us. Remember, these customers have purchased the good and agreed to pay later. For some folks, they don't pay when they are supposed to for whatever reason. And how do we account for that? How do we deal with that? And what we do is every year, we're going to record what's called bad debt expense. Record bad debt expense, and I'm going to label that AJE. Stands for adjusting journal entry. So every year, as part of the adjusting process, we're going to record bad debt expense. And let me give you the entry to record this. So what you're going to do is you'll debit your bad debt expense account. And you'll credit an account called the allowance for doubtful accounts. Credit our allowance for doubtful accounts. Now, when I look at that adjusting entry, the bad debt expense part of that is pretty straightforward, right? I know what type of account it is. It's an expense account. It's telling me right there in the name, it's an expense account. However, the allowance, which is a new account for us this week, isn't quite as obvious. Can I just ask, just to kind of get us off and started this evening, give me a volunteer, turn on your mic and tell me, what type of account is the allowance for doubtful accounts? Aiden, I think your microphone turned on first. Aiden, what type of account is the allowance for doubtful accounts?
It's a contra asset account.
Very good. Aiden, just a couple more quick questions, please. Let me write that first. Absolutely right. The allowance for doubtful accounts is classified as a contra asset account. Aiden, another question. What exactly does that mean to be a contra asset account?
Well, it does the opposite of what a normal asset would do. So if you're going to debit an asset, you would credit this specific account.
Agree. And let me ask it this way, Aiden. The contra asset, the allowance for doubtful accounts, does it have an increasing or decreasing effect on our asset?
Would it be decreasing?
Absolutely right. Contra means to reduce. So any contra account is one that has a decreasing effect on what it is contra to. So the allowance for doubtful accounts, a contra asset, results in a decrease to our assets. Aiden, good. Aiden, can you turn the mic back on? One more question, please.
Yeah, go ahead.
Good job. One more question. You kind of already answered it. I just would like to hear it again. Can you tell me, debit or credit? What is the normal balance for this account?
It would be a debit.
Say that again.
Credit.
That sounds like a better answer. Very good. The allowance for doubtful accounts, a contra asset account. one that has a decreasing effect on our assets. The normal balance for that would be on the credit side of the account. All right, good job, Aiden. You can go ahead and mute your microphone. I have another question. I'd like to maybe ask a new voice, please. So now that we know what the adjusting entry is to record bad debt expense, there's something awfully important about the amount that we record as bad debt expense. Can somebody tell me what is that something awfully important? What do you know is true about the amount recorded as bad debt expense? Give me a new volunteer, turn the mic on and tell me. Bad debt expense is an blank. Fill in the blank.
An estimate.
Oh, Dominic, good job. Hey, Dominic, I'm gonna one more question for you in a minute, but I think that's awfully important. I want to write that down. In fact, I'm gonna jump over to another piece of paper. The amount that's in that adjusting entry, the amount that we record as bad debt expense is an estimate. We need to estimate our bad debt expense. The amount recorded as our bad debt expense is an estimate. Dominic, can you turn mic back on, please, for a second? I'm going to be greedy tonight, Dominic. You're absolutely right. It's an estimate. But can you tell me why? Why is it we need to estimate the bad debt expense?
It's a tough question.
You know, every once in a while I happen to stumble onto one.
Does it have to do with the recoveries?
It really does. I don't think it is an issue of recoveries. You can go ahead and mute your microphone. I'll give somebody else a chance if you want to jump in. Why, Chloe, why is it that bad debt expense is estimated?
Is it because you don't know if people are going to pay their debts or not?
You know, Chloe, I like that. I want to follow up here in a second, but let me lay something out for everybody. Here's what she said, and I agree with this. She said, look, we don't know when we sell goods to customers, which customers will and will not pay us. I mean, if we knew that in advance, we simply wouldn't sell goods to the customers that weren't going to pay. But we don't know that in advance. But Chloe, then here's my follow-up to you. So, okay, that makes sense, except why not just wait? You know, because at some point, we're going to learn which customers aren't going to pay. So why not just wait until we do and then record bad debt expense at that point? Why estimate it?
Because it could be in a different accounting year.
You know, you are very close. There's something more specific I need to hear, but I like where you're at. I just need to clean that up a tad. Can Chloe, you got to mute your microphone. Can somebody just add one little piece to that? She's real close. There's something specific that requires bad debt expense to be estimated. Matthew?
Is it because it happens at the start of the year?
Matthew, I don't think it's the timing of that. So that's not the start of the year. Keaton, give it a shot.
Is it because of the matching concept?
Keaton. That sounds like a good answer. Do you mind telling us what exactly is the matching concept?
You have to record your revenue when it is earned.
That sounds like the realization principle. The matching, and he's right. In fact, I want to add, let me help a little bit. I want to add what he said. The amount recorded as bad debt expense is an estimate, and it is estimated due to our friend, the matching concept. And what the matching concept says, Keaton, it's not related to revenues. Like I said, that's the realization principle. What the matching concept says is our expenses must be recorded in the same year that the related revenue is earned. And the revenue is earned when we make the sales. But we don't know at the time of making the sale which customers will and won't pay us. So in order to conform to the matching concept, we record our bad debt expense as an estimate in the same year that the sale happens. That way the expense is matched to the revenue. That's kind of a big deal. Because really, almost all of our calculations and our work in this week's topic are going to be related to the fact that we have to estimate bad debt expense. We'll learn how to do that in just a little bit. We've got a couple more foundational things to put up here. But are there any questions on what we've seen to this point? Like I said, a couple more foundational things that I want to go over. The first thing is something called your net realizable value, or NRV. And your net realizable value is calculated by taking your asset. That would be the accounts receivable. Don't take your accounts receivable and subtract the contra asset, the allowance for doubtful accounts. Accounts receivable minus the allowance gives us something called the net realizable value. And one thing to maybe make note of, exam 2, I know it's about a month away, but exam 2 is much more calculation focused than exam 1 was. Exam 1 had a lot more sort of conceptual stuff. So you've got to be able to do calculations kind of like this. You come up with the NRV, accounts receivable, minus the allowance. The other thing that I would like for you to put into your notes is, with this week's material and this week's calculations, the vast majority of them will eventually require us to create a T account for the allowance for doubtful accounts. So let's do that. Let's set up a T account for the allowance. Our allowance for doubtful accounts. And we have already heard earlier tonight that the allowance is a contra asset with a normal balance of a credit. So that means our beginning balance and our ending balance will be found on the credit side of the T account. And one of the things that we're going to have to be able to do is construct this T account. We need to know what goes in here and where. And you guys look at this for a minute. When you record your bad debt expense, every year is part of the adjusting process. When you record bad debt expense, notice the credit here we credit the allowance for doubtful accounts. So the credit side of the allowance is this amount, the amount of your bad debt expense. So you'll find bad debt expense on the credit side of the T account. That's an increase. The debit, the decrease side, that would be what's called our write-offs. A write-off is where we have said, you know what, we've tried. We have tried and we've tried and we've made a concerted effort to try to collect this money from this customer. And the customer just isn't paying. And at some point, it is no longer worth our effort and time, and most importantly, money, to try to continue collecting from the customer. And when we reach that point, we simply write the account receivable off the books, and we are no longer actively trying to collect that cash. Now, it's not common, but it can happen. After you have written somebody off, maybe they end up paying you. That's called a recovery. And a recovery only can happen if you had a write-off first. And a recovery is basically going to reverse the effect of the write-off. The write-off is on the debit side of the account. To reverse that, our recoveries belong on the credit side. And that's an awfully important T account. That's one that we're going to use a lot in our calculations this week. So you want to know it. You got to know. I think we can go ahead and take a look at our problem. But before we do that, are there any questions on this foundational content that we just talked about? All right, well, very good. Then let's take a look at our example. Let's just read it so we know what it says. At the beginning of 2026, Easy Tech Company's accounts receivable totaled $140,000, and the balance in the allowance for doubtful accounts was a $2,350 credit balance. During the year, Easy Tech reported sales of $1,050,000, all of which were sales made on account. Collections from credit customers during the year totaled $670,000. During 2026, the company wrote off as uncollectible accounts receivable totaling $4,000 and recovered $5,000 of accounts that had been written off in 2025, the previous year. At December 31, 2026, Easy Tech prepared this following aging schedule. And you guys take a look at it for a second. An aging schedule simply takes all of our accounts receivable and puts them into different categories by age. In the example that I have given you, I've given you 4 age categories. Those receivables that are not past due, 1 to 30 days past due, 31 to 75 days past due, and then over 75 days past due. So we categorize our receivables into one of those categories, and then for each category, assign a percentage expected to be uncollectible. And it's really no surprise, right, that the older the receivable gets, the greater the likelihood of never collecting the money. Hence, the percentage expected to be uncollectible goes up. In our first order of business, the real heart of this week is to learn how to do this. how do we estimate our bad debt expense? And there are actually two acceptable techniques. We have two ways that we can come up with our bad debt expense estimate. Let's start with this first. The first way of estimating our bad debt expense is called the net credit sales method. We can use our net credit sales method. And the net credit sales method, the way in which it estimates your bad debt expense, we will calculate our bad debt expense by taking the net credit sales for the year, the sales that we made to our customers. Take our net credit sales and multiply that. And here's where the estimate comes in. Multiply that by the percentage that we estimate of those sales that we won't collect. Multiply by the percentage expected to be uncollected. Now take a look, and let's just come back here for a moment. Take a look at the first two requirements of our problem. And it tells us for requirements A and B, assume that Easy Tech Company is using this method right here. Assume they use the net credit sales method to estimate their bad debt expense. And they have estimated bad debt expense to be 3% of their net credit sales. Requirement A wants you to calculate the bad debt expense estimate for the year. There's the equation. But it's one thing to know the equation. Different ballgame to put the correct numbers into the equation. I'll take anybody if you want to give it a shot. Somebody want to try to give me the numbers from our problem to calculate your bad debt expense using this net credit sales method. I will tell you, this is actually it's the easier of the two, but he wants to give it a shot. What does it tell us? It says, okay, we want to take our net credit sales, the sales we made on account. And here's what the problem has said. During 2026, Easy Tech reported sales of $1,050,000, all of which were sales made on account. So we'll calculate our bad debt expense by taking those credit sales, which were $1,050,000, and it told us here in the requirement, it says assume that bad debt expense is estimated to be 3% of our net credit sales. So multiply that by 3%. And our bad debt expense estimate using the net credit sales method, $31,500. Are there any questions on that calculation? Everybody okay with where I got my numbers? Any questions like that? Well, then take a look at requirement B. Requirement B wants us to calculate the net realizable value of Easy Tech Company's accounts receivable at December 31st. And we remember it's right here. The equation to calculate the net realizable value, accounts receivable minus the allowance for doubtful accounts, which means we need to come up with the balances at December 31st for accounts receivable and the allowance. And I think the best way to do that is let's set up a couple T accounts. Let's create a couple of T accounts here, one for accounts receivable, one for the allowance. And let's come up with our balances as of December 31st. There's accounts receivable. And we'll put the allowance over here. And I will give somebody a chance if they'd like to try it. Pick one of the two. One of the two accounts and tell me the numbers that go into our T accounts. How would you get to the balance at December 31st? All right, Matthew, very good. Matthew, which of the two do you want to do? The accounts receivable or the allowance?
The allowances.
All right, Matthew, you tell me what numbers are going to go into that T account.
All right. So you in the problem it says that they wrote off $4,000 worth of stuff, so that would go on the debit side of the account.
Good. We know, right? We've already written out a T account for the allowance earlier today, and we know that the decrease, the debit side of the account, represents the write-offs that we have recorded. And the problem told us, just like Matthew said, during 2026, the company wrote off as uncollectible accounts receivable totaling $4,000. Good job, Matthew. Keep going.
Right. And then the other stuff, or the stuff that goes on the credit side of the account would be the starting balance for the allowance.
How much?
That would be $2,350.
Very first sentence of the problem says, at the beginning of 2026, blah, 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 the allowance for doubtful accounts had a balance of $2,350 on the credit side. We'll say 2350, January 1. Keep going, Matthew.
Later in the problem, it says during 2026, they recovered $5,000 worth of accounts that had been written off the previous year.
So where does that go?
That would go on the credit side.
Of course. We know that any recoveries that happen are an increase to the allowance. They're a reversal of a write-off. So we'll put those on the credit side. Anything else?
You would credit the bad debt expense for the year.
How much was that, Matthew?
That was $31,500.
We just figured it out, right? We just calculated the bad debt expense right there, 31.5. Excellent job, Matthew. Well done. That goes on the credit side of our T account. I can fit that in there. Bad debt expense. And that lets us figure out the balance at December 31. You guys know how to work a T account by now. And at December 31st, the balance is $34,850. All right, that's good job. Excellent work, Matthew. Well done. That is a must know. You must be able to come up with your T account for the allowance. Any questions on what he did? Do I have another person who wants to give it a shot? Accounts,
I just have one question. How did you get the 34,850?
the ending balance,
Yep.
add the increases, subtract the decrease.
Okay.
So it's just working T account like we did, goodness, when we did transaction analysis, just coming up with the ending balance. Any other questions?
Can you repeat how'd you get 34,850?
Sure. So you just add up the increases, the credit side,
Okay,
subtract the decrease,
okay.
debit side. Do I have a volunteer that wants to try the accounts receivable? Come up with the balance at December 31 in the accounts receivable account. Any takers? Well, let's see if I can figure this out. It tells us at the beginning, the very first sentence, at the beginning of 2026, the accounts receivable balance was $140,000. It's an asset, normal balance on the debit side of the account. Or January 1st balance, 140. And then I know what an account receivable is. It represents money owed to me. So that balance goes up. More money is owed to me every time we make sales. And we know that we had sales of $1,050,000. So we'll have an increase here of our sales revenue. The decrease, well, one of them would be the cash that we've collected, right? This is money owed to me. When the customers actually pay us, it is not owed to us anymore. And the problem did tell us collections from credit customers during the year totaled $670,000. So the decrease here would be our cash collections. And honestly, at this point, I'd expect everybody to be able to come up with that part of the T account. We've done that before. So you should have been able to piece together those parts. But there's one thing that's new to us this week that if you're going to mess this up, it's probably going to be right here. The other decrease to your accounts receivable come from a write-off. So a write-off is a decrease to the allowance, and it is also a decrease to your accounts receivable. So I do need to put the 4,000 of write-offs on the credit side of the account. So we work the T account, right? We add the increases, subtract the decreases. And we can figure out that the balance in the accounts receivable at December 31, $516,000. Okay, we'll finish it up in a second. But are there any questions on any of the numbers, any of the work that was done to calculate these two balances? Well, what they've asked for is the net realizable value. See if I can fit that in right here. They've asked us to calculate the net realizable value of our accounts receivable at December 31, 2026. And we know our equation to calculate the net realizable value right here. Accounts receivable minus the allowance for doubtful accounts. Accounts receivable, December 31, 516,000. Minus the allowance at December 31, 34,850. Giving me a net realizable value here, 481, 150. All right, like I said, exam 2 is going to be a lot more calculation oriented. And some of those calculations are things just like this. Need to be able to set up the T accounts, come up with the ending balances, calculate the NRV. And we definitely need to be able to come up with our bad debt expense. So far, we've seen this first method, the net credit sales. Are there any questions at all before we look at the other technique? Well, then let's take a look at our other method that we have to estimate our bad debt expense. And it's called the aging method. In this aging method, this is where we're going to make use of that aging schedule. Or aging method. Now, one thing I want you guys to recognize, the aging method and the net credit sales method, they are both techniques that we can use to estimate our bad debt expense. But that's all they are, techniques to come up with an estimate. Both are fine, but they give different values, and we would not expect to end up with the same estimate using both of these methods. So we don't be surprised when we use this other method and we come up with a different estimate of our bad debt expense. Perfectly okay. The way the aging method is going to work is we're going to make use of the aging schedule. So from the aging schedule, what you're going to do is you're going to take the amount of the accounts receivable. Remember, the aging schedule puts the receivables into different categories by age. So we're going to take the amount of the accounts receivable and you're going to multiply that by the percentage expected to be uncollectible for that category. So multiply by the percentage expected. To be uncollectible. And we're going to do that for every category in the aging schedule. See if I can fit that in. There we go. And you're going to sum the products. So that's what that thing means right there. In fact, if you guys don't mind, let me do it. Can you guys, in fact, look at this for a quick second. Right here was our aging schedule. And they had prepared this aging schedule at December 31st, 2026. And notice, taking all of our receivables, putting them into these different age categories, notice the total here at December 31, 2026, the total accounts receivable, we have 516,000, which is exactly what we had calculated through the use of our T account. So what I'm going to do is I'm going to take the amount times the percentage for each of these categories. Here's what we got. 400,000 times 3% plus 70,000 times 6% plus 30,000 times 10% plus 16,000 times 40%. When you press your buttons, we've got 12,000, 4,200, 3,000, and 6,400. Adding them up, total amount here is $25,600. Here's the trick. Do not call that bad debt expense. Resist that temptation. That is a very common mistake. Please don't make it. That is not your bad debt expense estimate. Can somebody, and I'll take anybody on this, can somebody tell me what is it? What does the number from the aging schedule represent? Casey, what does this number from the aging schedule represent?
Your ending allowance balance.
Good job. Absolutely right. Don't call it bad debt expense. You know full well, I'm going to ask you a question on exam 2. Hey, here's some information. Use the aging method to calculate bad debt expense. And you know full well one of the choices is going to be 25,600. And not the right choice. This number from the aging schedule, in fact, I think that's worth us writing. This number from the aging schedule, this calculation in blue, the 25,600. This represents the ending credit balance in the allowance for doubtful accounts. So your ending credit balance in the allowance for doubtful accounts. Casey, can you turn your mic back on for a minute? All right, Casey, you are absolutely right. Good job. But this is the ending balance. They've asked us to come up with the bad debt expense. Any suggestions on how to do that?
Make a T account for an allowance and then force it out with a variable.
Here we go again. Right? In order to do the majority of our calculations, we need to have a T account. We need to be able to work with a T account for the allowance. So Casey, come on back. Let's do that. We'll set up a T account. The allowance for doubtful accounts. Casey, you tell me what numbers and where do they go in this T account?
For debit, it would be our write-offs for 4,000.
Of course, right? The write-offs are the decrease to the allowance. And we know they were $4,000. Goes on the debit side of the account. Continue.
And then on the credit, it would be our beginning balance, which is 2,350.
On the very first sentence, it said, at the beginning of 2026, the balance in the allowance was 2,350 on the credit side of the account. January 1st, 26, 2,350. Continue.
And then we would have our recovery account, which is 5,000 for on a credit side.
We know that one of the increases to the allowance is the amount of our recoveries given as 5,000. Continue.
And then our bad debit expense, which is our X to find
What side of the T account?
on credit.
Of course. We know the other increase to the allowance is the bad debt expense. We don't know what that is yet. That's what we're trying to solve for, which is why Casey said make that an X. That's our bad debt expense here. Finish it, Casey.
And then we need to put in our ending balance, which we just found was 25,600 on the credit side.
Good job. That's excellent work. You mute your microphone. Well done. We know from the aging schedule, we did this calculation, and we get the ending credit balance in the allowance for doubtful accounts. And that ending balance here in our problem, 25,600. And now it becomes a matter of working the T account, right? You guys know how to work T account. I'll do the arithmetic here just so you can see it, but you should be able to do it. 2350 plus 5,000 plus X minus 4,000 equals 25,600. Solving for X, the bad debt expense estimate for the year using the aging method, 22,250. That's a good one. That's a real good one. You definitely need to be able to do the calculation for the aging method, bad debt expense. Any questions on what Casey did there? All right, I'll ask another question. I kind of think this one should be easy. How about a new volunteer? Based on the work we've done, I think you ought to be able to answer this one. Requirement D, still using the aging method, wants us to calculate the NRV, the net realizable value of the accounts receivable at December 31st. Net realizable value at December 31, 2026. Can a new volunteer give me the numbers? How are you going to come up with your NRV? All right, Grant, excellent. Your microphone turned on, Grant. Give me the numbers to do this.
You do your accounts receivable, which is the 516,000,
Keep going.
minus your allowance for doubtful accounts, which is the that 25,600.
That is an excellent job. Well done, Grant. You can mute your microphone. Absolutely right. He just told us how to do it. He said the NRV is our accounts receivable minus the allowance for doubtful accounts. And we already know. We did a T account earlier this evening, and we calculated, let's see if I can actually put my hands on it here. We calculated our accounts receivable at December 31, 516,000. They also told us in the aging schedule, right? At December 31st, total accounts receivable, 516,000. Using the aging method, we had figured out that the balance in the allowance for doubtful accounts at December 31 was 25,600. which gives us a net realizable value here, 490, 400. Okay, are there any questions on either of our techniques for estimating bad debt expense, either net credit sales or aging? All right, very good. We got one more calculation to do. And in letter E, they want us to calculate a couple of the ratios that we learned this week. And what I'd like to do, I'll do most of the work. I'll give you the equations. I would just like to see if somebody can give me some numbers. The first thing that they ask us to calculate is the accounts receivable turnover ratio. And to calculate the accounts receivable turnover, let me give you the equation. Your AR turnover is calculated by taking your net sales, the sales that we made during the year. So we'll take our net sales revenue and divide that by what we'll call our average accounts receivable. Net sales over the average accounts receivable. Can somebody give it a shot? Preferably a new voice. What number belongs in the numerator of this equation?
1,050,000.
Job, Dominic. Stay with me, please. I'm going to ask you for another question in a minute. We are told in our problem that they had sales all on account $1,050,000. So our net sales revenue for the year $1,050,000. Dominic, we'll come back to this page in a minute. But let's jump over here to another piece of paper for a moment. The numerator in this equation is the average accounts receivable. Are you able to tell me, Dominic, how do you calculate the average accounts receivable?
Oh, we take the beginning accounts receivable balance and we subtract it from the ending, and then you divide it by 2.
Dominic, you're so close. You made one little mistake. I'm gonna give you one more chance.
Was it the ending minus beginning?
No, I don't want to do that. In fact, I want you to take that minus sign out of there. Give you one more chance.
Oh, you add them together and divide by 2, sorry.
Yeah, that sounds much better. To come up with an average. You guys remember this. We'll see it again next week. To come up with an average, anytime you see that average, that is the beginning balance plus the ending balance divided by 2. In fact, let's write the equation. So we'll say that's our beginning accounts receivable. I'm going to abbreviate AR, accounts receivable. Beginning accounts receivable plus our ending accounts receivable divided by 2. Dominic, can you come back and give me the numbers?
Yeah, so our beginning is 140 and our ending is 516.
Great job. Excellent job. You got to mute your microphone, but well done. We know, right? The very first sentence of the problem said at the beginning of 2026, the accounts receivable was $140,000. We did a T account and we're able to determine at December 31, the end of the year, the accounts receivable, 516. Add them up, divide by 2, and that gives us an average accounts receivable, 328,000. And that is the number that we will put in the denominator of our ratio. So if I bring this one back, we have our sales of $1,050,000 over the average accounts receivable of 328, which gives us an accounts receivable turnover ratio of approximately 3.2. Now, once we have this one, coming up with the second ratio is actually pretty easy. In letter E, they also ask us to calculate our average collection period. I'm just going to put one more piece of paper up here. To come up with the average collection period, what you'll do is take 365, right? The number of days in the year. 365, and we'll divide it by that ratio we just calculated. The accounts receivable turnover ratio. So we end up with 365 divided by 3.2 and an average collection period of approximately 114 days. I said it a couple times tonight. Exam 2 is much more calculation focused. And these are the calculations that you need to be able to do. You need to be able to use the net credit sales method to estimate bad debt expense. You need to be able to set up T accounts, come up with ending balances in the accounts receivable and the allowance to get to your net realizable value. You definitely need to be able to, if I can find it here, you definitely need to be able to use the aging method. Come up with the bad debt expense estimate. Remember, the aging method, what you come up with here is not bad debt expense, the ending credit balance and the allowance for doubtful accounts. We then take that to the T account to figure out the bad debt expense. And you need to be able to handle these couple of basic ratios, the accounts receivable turnover and the average collection period. Are there any questions on any of the work that we have done together this evening?